This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Help attract more borrowers and build a more resistant loan portfolio. Payment Guard Insurance from TruStage is a first-of-its-kind insurance solution designed for digital lenders to do just that. Visit www.trustage.com/payment-guard to learn more and talk with a member of the TruStage team. Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson, and I am just delighted to bring you a special episode with a very special guest. This week, I am delighted to welcome Danielle Sesko from TruStage. Danielle, I think we've talked many, many times, but this is the first time we've ever done a podcast together. Thanks so much for coming on.
Yeah, absolutely, Alex, and thank you for having me. I'm excited to be here.
I'm delighted to have you here because this is a topic that I have covered on a number of different fronts. But again, we've never really had an on-the-record, recorded conversation about it. And I feel like we're going to get into some areas maybe that we haven't touched on as deeply before. So before we do that, would you mind giving a little bit of an introduction and background on yourself? And then also just a little background on TruStage for those who may not be familiar.
Absolutely. So I started my career back in the 2008-2009 financial crisis, which was a pretty financial career, I should say, which was a pretty tumultuous time in our country and our business sectors. And my job was at that point to assist with the liquidation, mergers, acquisitions of failed banks through FDIC-assisted acquisitions. So it gave me a really unique lens of the banking world and the importance. What I thought at that time was, wow, how incredible was it that we had deposit insurance so that as these companies failed, we still had this safety net or this backstop for consumers to still get their access to their deposits through those transitions. So, and there was a significant amount of bank failures during that time. It was roughly over 400 from the period of 2008 to 2010. And comparing that to today, we had some recent larger bank failures recently, but typically we do see about a dozen or so bank failures per year. So definitely a significant amount back in the 2008, 2009, 2010 timeframe. But what I will say that experience did do for me is it really started to kind of turn the light bulb for me and increased my appreciation for insurance. And I don't hear a lot of people say that they're excited about insurance, see the value of it. But for me, it provided a lens of the value that insurance can provide to an economy, to a financial system, and then to an end consumer. Insurance is more than just the ancillary add-on product that sometimes gets sold by a highly compensated insurance agent to a consumer. It is a product that actually fuels our economy. It provides financial stability, allows for rational risk-taking. Now, fast forward to where I am now in my career. Over the last 10 years, I've been working in the insurance industry with a purpose on creating new products to keep insurance relevant for middle market consumers. That's been always my focus, my lens of how can we revise and iterate our insurance business lines to remain relevant to middle market consumers. And that means ensuring that we have the product structured to protect against the risks that they're concerned about and are priced for and that are affordable and easy to access. And currently I'm with TruStage, which is a phenomenal company. If you haven't heard of it, we're headquartered out of the Midwest and we're a national insurer. We protect about 37 million consumers throughout the U.S. We have about 32 billion assets under management. And one of my favorite stats about the organization is we've been around for about a century. So back in 1935 is when we were founded. So I won't use the word old, it's very mature, wise, established company, and also very financially stable as well.
Awesome. Well, thank you for that introduction. For whatever reason, maybe we hadn't covered this before. I wasn't familiar with your background in financial services, but the importance of insurance and being able to transfer risk around is the focus of our discussion today. So I can't wait to dive into some of those details a little bit more, but to start with, there is a category of insurance that has actually existed for quite a while that I was just not terribly familiar with, ironically, until you and I started having conversations. But for folks who maybe are a little less familiar, we're going to hone in on the area of payment insurance and payment insurance specifically in the context of consumer lending. So before we really delve into the details of that, Danielle, can you just give us in very broad terms a description of what payment insurance is and how it works, just in a very general overview?
Absolutely. So, payment insurance is not new. It's been around, as you mentioned, for a few decades, since the early 1970s, in the form of credit insurance, which still exists today. And then debt protection is one of the other more common names in the industry. And what payment insurance is, it's a type of insurance or cash flow protection product that's truly connected to the loan. So when a consumer goes through the lending process, they need to take out a loan for another purchase or an unexpected event. They have the option to purchase one of these products. They pay for these products on a monthly basis. And how it behaves and acts is if the consumer has one of the covered events, whether it be a loss of life, job loss, or disability, that insurance product kicks in and pays off that consumer's outstanding loan, or may pay for a set number of loan payments depending on its structure.
Okay, so that makes a lot of sense to me, right? So the conceptual idea, as you just described, is it's insurance that's connected directly to the loan. And really, like the purpose and the way I've come to kind of think about it is it's designed to sort of protect disruptions to a consumer's cash flow, which might negatively impact their ability to repay the loan. So in a lot of senses, I mean, I view this really from a, like when I think about it as the lender and as the borrower, it's really a win-win, right? Because everyone wants the borrower to keep making on-time payments to the loan. I say this often in other contexts, but in a lending context, the absolute worst thing is for someone to miss payments and fall behind on their payments. Like there's no one who wins in that scenario. And so preventing that, particularly in the case of specific conditions that disrupt a consumer's cash flow, makes a ton of sense. However, and this is the part I've always been a little bit stuck on, outside of specific areas like maybe mortgage is a good example, a couple of other use cases, payment insurance is not as ubiquitous in consumer lending as I might expect, given just sort of the intuitive sense that it makes for all the different stakeholders in the ecosystem. Why do you think that is?
I think this goes back to how the products are sold and not bought. And over the years, traditionally, these sets of products have been consumer opt-in purchase, where the consumer has to pay for it. So they have to already have some underlying concern for the risk of job loss or disability. And those are important products to have. But I think about ubiquitous. I think about holistically covering a book of business. And insurance works best when we have large pools of risks that we're covering so that we can effectively transfer risk from the lender to the insurance company. And with a consumer opt-in and paid solution, take-up rates are going to be just a fraction of that entire protected pool. So
Yeah.
that's one of the reasons why it hasn't been ubiquitous across all loan types and all across all lenders, is that it's been limited to just a selection of a margin of consumers who opted in for the protection. So as I think about what the value of those types of solutions can have going forward, especially, and you mentioned as well, Alex, of what insurance is supposed to do is help protect against cash flow disruptions, whether it's for job loss or disability. It's not that it prevents those things from happening. It's not a protection product. It allows for the resilience for both the lender and both the borrower, which is a win-win for both of them. So as we think about insurance or the payment insurance going forward, where there's the biggest opportunity from our perspective is covering the entire pool of loans. So it almost as portfolio wrapper, so that all borrowers have that protection built in as a component of the loan. Because unfortunately, bad things do happen to good people, unexpected job losses occur, disabilities occur, and consumers often do find themselves to be struggling to make their loan payments when those situations happen. And that's an impact to the borrower, their credit score, as well as the lender, who then has to essentially price and adjust their rates for the increase in defaults that they're seeing from their borrowers that they're working with.
Right. Yeah. I mean, the thing that's really interesting to me there, well, a couple of things. One, this idea that insurance is sold and not bought, I think is one that I think that's kind of a cliche almost at this point in the insurance space. But there's truth behind it, right? Which is that just from a consumer's perspective, insurance is not like a product people want to buy. It's not something they go out of their way to get. I think a large part of that is due just to the sort of human psychology of I don't really want to think about, like, we're terrible at managing risk as consumers, right? Like, we don't want to think about, I'm going to lose my job or I'm going to get disabled. Like, even though that may very well happen and no one who it happens to intends for it to happen, people don't want to think about that. And if they don't want to think about that, they don't want to think about what ways they might want to mitigate that risk. And so it's a very, very difficult product to proactively sell. And then to your point, not only does that affect take up in terms of if you're going to sell it on sort of an individual add-on basis, but also, and this is a concept that should be very familiar to folks listening who've worked in lending, you do have that adverse selection problem too, right? Where the folks that do decide to take up that protection, much in the same way that, folks who tend to persist through online lending underwriting processes that are particularly onerous, there's a reason that they're choosing to do that. There's a reason that they're persisting in going through that process. And oftentimes it's because they know something that the lender doesn't. And obviously insurance deals with that same adverse selection risk. And so my guess would be, and correct me if I'm wrong here, Danielle, but when you add it as that add-on product, not only are you just going to get kind of bad uptake overall, but you're going to see probably a riskier set of consumers choosing to opt into that than you ordinarily might want to see. Is that a fair assumption?
Absolutely. When it's an opt-in solution, or the harder we make insurance for individuals to access, the higher risk of adverse selection or anti-selection risks that occurs within that protected pool of borrowers, versus when we
Yep.
really, and what we should focus on in the insurance industry is really spreading our risk across multiple
Yeah.
segments and protecting as many people as we can, making the products easy to access, easy to understand, and as a embedded component of whatever non-insurance solution that they're working with. That helps to, when we have that really broad pool of protected consumers, that helps to ultimately lower the rate for everyone that's being
Yep.
protected, because we're lowering our risk on a unit basis. So absolutely, those models do tend to have heightened risk of adverse selection, which then in turn means as an insurance company, we need to price for that risk. We have a higher price point product to cover that risk for everyone that we are protecting, which then unfortunately is one of the aspects that makes insurance less accessible to everyone.
Right. Well, and I think it even impacts kind of downstream choices that you make from a product and a service experience, right? Like, I mean, if this is a high risk pool, highly priced, there's also going to be an incentive to, make the product, like harder to access, harder to get claims reimbursed against. So like it tends to sort of, I would think, impact the entire life cycle of an insurance product. So to your point, a lot of this comes down to the initial upfront design and how accessible you're making it and how broad a pool you're able to build. So building on that point, then, the thing I really want to dig into is the modern case for payment insurance to be more of a sort of ubiquitous product. And I've written about this in the newsletter before. In fact, disclosure, I did a wonderful sponsored deep dive in the newsletter with TruStage, where we actually looked at some of this. And part of the case I made in that piece that I really do very much believe in is this idea that insurance is kind of this missing component to the modern digital lending stack. And so I want to unpack why I think that and sort of what goes into that. What are the main arguments for, now that we have kind of a modern lending ecosystem, why insurance is such an important piece of that? So to start with, I think, Danielle, one of the things I wanted to talk a little bit about is the just rise of digital lending generally. And, I again, thinking about these sort of older products that were appearing in the 70s, 80s, 90s, I think it's important to think about the context in which those products were distributed, right? And so if you're doing payment insurance or credit insurance and you're a lender, likely in the 70s or 80s, your distribution was through branches, right? Like you were reaching customers in an in-person context. The way you competed for those customers was you built physical distribution channels in places that other lenders couldn't reach. And so you had different communities that you served. You had sort of a geographic distribution advantage, or in some cases, a monopoly on getting to those customers because you were the only game in town. And obviously, they were sold as an add-on product. I think in a lot of cases, they were sold by like an individual at the bank that maybe was financially compensated to sell additional products. So the context of how these things were sold was very much based on the distribution models that were available at the time. Obviously, you fast forward to today, I think one of the most important kind of takeaways about sort of how lending works today and the competition in lending is everyone's on an even playing field, right? Everyone can get loans digitally now. And what that means is we've flattened out the competitive field. And suddenly, if you're a lender, you don't have the same right to win geographically that you might have had before. You don't have those same sort of unique branding advantages. You're just one of many different choices available through Google or through a lead aggregation website. And your product is being sort of compressed into a very different competitive landscape. I'm curious if you can articulate why payment insurance is potentially something that's useful to digital lenders given that sort of evolving competitive context.
I'd like to start out too a little bit just kind of emphasizing what are the main factors that's been driving that rise in digital lending, because that relates a lot to the relevancy of payment insurance in the ecosystem. And the first factor is asset intermediation. We're seeing non-bank financial institutions hold nearly 6% of the private sector's total financial assets. And that's been on the rise since 2009 when the figure was just 48%. So what that means is we're seeing non-lenders acting as, from the consumer's perspective, as lenders. In reality, they're technology companies. And what's enabling that to happen is the commoditization of tech. You mentioned that as well. That's allowing those businesses to iterate and create new products faster than it's ever happened before. And then combine that with an acceleration of consumers' expectations around the digitization of lending. So those three factors combined has really led to this rise of digital lenders. And when we think about the kind of foundation of what led to that rise, it changes the kind of structure of insurance and increases the need and relevancy for it. Whereas before, payment insurance might have been sold directly to a financial institution where they might distribute it through a face-to-face experience with a loan officer, those same products are not as relevant and actually can't be accessed by a technology company that is now distributing loans to a borrower. So as we think about the changes in payment insurance that need to occur, one of the things as we think about that change of what happened with the digital lending landscape, one of the things that you mentioned is the competition that existed. Really, loans have become commodities online where consumers are shopping based on rates, based on the affordability of the solution that they're looking at. They're looking less at the brand that they're getting the loan from, provided that's a reputable company. So what we're seeing from our experience in digital lenders is the insurance products that traditional financial institutions may have access to, digital lenders do not have access to those products. But yet they have a need for those products to remain differentiated in the marketplace and to protect against their own risk of losses, even if they're not holding the loans directly on their own balance sheet. So what I would point to as the kind of relevancy and need for payment protection for those lenders is really kind of differentiation, a need to reduce their marketing, their acquisition costs, remain more competitive when they're on a loan marketplace site or an aggregator site, and they're looking to stand out as consumers are shopping for rate. And then secondarily, to ensure that the loans that they're creating from their platform or portfolio are performing well, are quality performing loans for their underlying lenders.
I want to talk about that second point a little bit more because, as you pointed out, really since the financial crisis, which is where you got your start working in financial services, so you saw this up close, one of the responses from the government and from regulators was to require banks to hold a lot more capital on their books, right? And so we wanted to reduce the amount of leverage in the banking system. And what that meant, practically speaking, was that there were entire sort of categories or products from a lending perspective that banks just really reduced their footprints in, right? Like we don't really care as much about small businesses because if we have to choose between holding capital on our books to cover loans made to, 1 million different small businesses versus, 100 large enterprises and commercial clients, we're going to pick the commercial loans and we're going to maybe deprioritize small business lending. Consumer lending, same thing, right? You see a shrinking of banks' sort of market share and footprint. And again, it's not necessarily because they didn't want to serve those customers or take those risks. It's just that, in a lot of cases, serving them directly became expensive, both from a balance sheet perspective. And then, as you're saying, as we've migrated into this digital world, from a cost to serve and a cost to acquire perspective, because suddenly they're up for grabs for everybody. So it just sort of changed right around that 2009, 2010 range. What has filled in the gap, and I think this is a large portion of the types of companies that you talk to, I'm sure, on a daily basis, Danielle, are, these digital lenders that step in. And they're not banks. They usually have a bank partner that they're originating. And the entire lending ecosystem wrapped around these new digital lenders has become much more specialized. So you have these digital lenders that are reaching out on the front end. They're acquiring customers. They're building sort of very specific value propositions for different segments of the market that they can go out and try to cost effectively acquire. They have a bank partner that they're working with, or in some cases, they might be originating the loans themselves using state lending licenses, but there's an origination process. And then after that, and this is the other part of the story here, is a lot of these loans are then being sort of transferred to investors in the secondary market, right? So listeners might be familiar with the rise of private credit as a space that's really exploded, particularly over the last 5 to 6 years. And private credit is just a way of saying that there are private investors, funds that are gobbling up lots of different types of assets. And one of their favorites is consumer loan portfolios that they are essentially buying the paper on. And that is another part of this ecosystem that's really popped up to provide the capital for a lot of this lending that's happening on the front end by these digital lenders. The reason all of this matters to payment insurance, and Danielle, maybe you can kind of comment on this a little bit, is a more specialized consumer lending ecosystem where it's not a bank doing every single part of the job and holding the loans on its books until they mature, that sort of very old-fashioned approach to lending. This new model we have where there's lots of different specialized players participating in the ecosystem, my perspective on that is that the ability to transfer risk and to make sure that every provider in the ecosystem can kind of play their defined role and do so in a relatively sort of capital light, risk light sort of approach, that really benefits from insurance and the ability to sort of transfer or move those risks around to the right place. How do you see payment insurance sort of fitting into this new sort of specialized lending stack that we've been building for the last 10 years?
I see it as a standard component of that lending stack where we talk about it should be ubiquitous to all loans. And as we think about the complexity of the consumer credit ecosystem or the capital ecosystem that allows lenders to lend and be successful, it should be a component of that because insurance, as we talked about at its core, is a risk transfer solution. It's not that we're dollar for dollar paying for premium versus claims, but what we're doing with insurance is that we are providing cash at the point when it is most needed for that borrower so that we prevent a loan from going into default. And right now, some of the studies we've seen from Cornerstone Advisors in particular is that all loan defaults are being driven from job loss or disability, roughly 20% related to job loss or disability. So if we can protect those defaults, prevent those defaults from occurring, what we're doing is we're allowing for capital to become more efficiently deployed. We're allowing for investors to have greater returns. And some of the recent regulations facing the traditional lending ecosystem, whether it's CECL or Basel III Endgame, are going to likely drive, it's been predicted, roughly at least a 15% increase in capital reserves. That matters because it increases the cost of capital for lenders within that ecosystem and decreases returns for investors, whether it's private credit lending or securitization to be another mechanism within the structured finance space for non-lenders to participate. When we increase the cost of capital to borrowers, fortunately what happens is that sometimes lenders become more restrictive in their underwriting and less people get access to credit and credit becomes more expensive. Now the role importance insurance plays is to reduce the cost of capital, to reduce the risk. And I like to believe long-term make credit more accessible to more people.
Absolutely. I mean, that I think is absolutely key. There's this idea, if you think about the way that private credit and, debt facilities and debt warehouses play in non-bank lending, The way a lot of times it works that's kind of unfortunate realistically is you'll have these non-bank lenders that are just starting out and they can't get any debt capital from anyone because their model isn't proven, their product isn't proven, there's a lot of risk associated with it. So usually they'll start by actually lending out of their equity and taking some of the money that they've raised for equity and lending off of their own balance sheet. And they'll try to do enough of that they can demonstrate their model. And then they'll go to different debt capital providers and they'll try to get an initial warehouse line or an initial facility that they can lend against based on that initial performance. Normally, they don't get very good pricing. And then they have to do a lot more lending. And then they use that performance to then negotiate their next warehouse or debt facility. And it goes on and on and on until they get to a relatively competitive position from a cost of capital perspective compared to a traditional bank or a much more established non-bank lender. One of the things I think is really cool to your point about the ability to protect that 20%, I'm glad you put a specific number on it, right? The 20% of defaults that are due to job loss or disability. The thing that's nice about being able to de-risk that is, particularly at the beginning, when you're early and you're trying to serve these customers, the ability to present a lower risk profile to investors and say, look, we may not have quite as much performance data on how we're doing. We're a little bit younger as a company, but we can lower our overall risk profile and make us a more attractive company to partner with to provide debt capital to, whether that's getting access to debt capital you wouldn't have gotten to before, or getting it at a more attractive price that then you can pass on to borrowers and use to be more competitive in the marketplace. I mean, people who are new to lending are surprised to find this, but cost of capital is ultimately the thing that drives a lot of the decisions you have to make downstream about how you build your business. So I love the ability to kind of add it in there. I want to pivot a little bit just to talk about the consumer side of this, because we've talked about how digital lending has changed the overall ecosystem, how it's made it more competitive, it's made it more specialized. The other thing that's changed, though, over the last 10 years is just sort of consumers' overall financial stability, right? And you can throw a rock and hit all kinds of different statistics about, consumers living paycheck to paycheck, consumers not able to afford a $400 emergency payment that was unexpected. But I think the general takeaway from a lot of those specific stats is that consumers, by and large, live relatively close to the edge from a financial services and a financial health standpoint. And I think what that means is that any disruptions to their cash flow, and again, job loss, disability, that's a big one, those can really meaningfully impact a large percentage of consumers, including some, going back to our earlier conversation, that maybe wouldn't have really sought out risk mitigation or insurance proactively, because even though they're kind of close to the edge and something could happen and could kind of tip them over, they don't necessarily think of themselves that way or behave that way, because that's kind of how a lot of consumers in the modern economy behave. What's your sort of take on just the state of consumer financial health in the US and how that impacts the need for something like this?
I agree. And as you mentioned, you can throw a rock and just about hit any other stat that you want to quote about consumer financial health. But really, where consumers are at is really at almost the precipice of being just one paycheck away from struggling to make a loan payment. And that could be due to job loss, or it could be a disability, or it could be some other unexpected event. And when they're that close to the precipice of having to make a decision on how they're going to make that loan payment, I've talked to consumers over the last 10 years, and I've heard all different scenarios of prioritization. I think my favorite ones is, I'll quote a consumer who would throw their bills up in the air and see which, remember the I Love Lucy episode? They throw their bills up in the air and see which ones landed face up versus face down. And that was their prioritization decision on how to allocate their limited funds. And that's a difficult position to be in, and not just for the consumer, but for the lender as well. So if we can have insurance solutions or loan payment solutions help those people out in their time of need of making that payment for the individual, so they can take away that thought process, that prioritization process, and we can protect their credit scores. We allow them to focus on other things that they need to spend money on, whether it's groceries or ensuring they have a car that gets their job. And the stats are unfortunate of the amount of time it takes sometimes people to find a job, even though we do have relatively low unemployment right now in the US, which is surprisingly low for the level that we're at right now and the duration of it. That's likely to change. But even still now, 20% of consumers who lose their jobs are out of work for at least 6 months. So that's 6 months without income, and that prioritization process just becomes more and more pressured of how they're going to pay their bills on a day-to-day basis. And when I think about insurance, we use this term previously as cash flow protection. It's if that cash flow disappears, insurance kicks in. Insurance is not a protection product. It's not a product that will make someone wealthy, but it is a product that will help to make someone more resilient when those unexpected things do happen.
TruStage Payment Guard Insurance is a first-of-its-kind insurance solution built for digital lenders, designed to help you attract more borrowers, strengthen your loan portfolio, and reduce time spent on collections, all with minimal tech lift needed to go live. To learn more about Payment Guard Insurance, visit www.trustage.com/payment-guard and speak with a member of the TruStage team. Well, I want to emphasize something that you mentioned before, because this idea that people are driving close to the edge or that they're right on the precipice, that is an idea that is applicable across different consumer segments. And I think it's worth emphasizing this because when you look at the stats on people living paycheck to paycheck, and this is like a self-reported statistic, I think Lending Club does a lot of surveys in this area and they've been doing them for years. And they'll ask consumers to report themselves, like, do you live paycheck to paycheck? And if so, sort of how close paycheck to paycheck do you live? And one of the things they find is that it's true across income brackets, right? And so obviously, I think the mental image we have of someone living paycheck to paycheck is someone, maybe working 3 jobs, and they're all relatively low paying jobs, hourly jobs, and they're really struggling just to make enough money to live. And that's certainly, there's a segment of consumers that fall into that bucket. But I think there are also versions of this same issue that crop up across different income brackets. And so you'll see consumers that make a very good salary. They have a, salaried full-time job. They make a really, really good income, but their expenses are such that they live relatively close paycheck to paycheck. They don't have a lot of savings built up. They don't have that sort of cushion that they can fall back on if they have to look for a job for 6 months. And so this disruption to someone's ability to pay is something that is sort of equally disruptive in a lot of ways, at least from a loan performance perspective, across income segments. And to your point about job loss and sort of the state of the economy, ironically, right now, it's much easier for consumers at lower income brackets to find a new job. That's where a lot of the sort of low unemployment rate is sort of playing itself out, is in those income brackets. But as we've seen in technology and a number of other sectors, there's layoffs, there's scarcity of new jobs you can find. I talk to folks in the Fintech ecosystem all the time who are looking for a new job and are looking for quite a while. And so ironically, both the disruption to someone's cash flow and the sort of struggle to find a replacement to that cash flow and to get a new job can impact higher earning consumers as much as it does lower income consumers, or even more so. And so that, to me, I think is just something I wanted to emphasize as it relates to lending, because you could have someone doing lending listening to this podcast thinking, well, that's a low socioeconomic status problem that I don't really need to be concerned about because that's not the segment of the market that I target. This is a problem that's kind of universal. Is that kind of your feeling as well?
Absolutely. And the thing I'd add to that, Alex, is it's a problem that affects not only all income segments or all sectors of the economy, but all credit scores as well. Credit score as a methodology to assess risk doesn't always assess completely that holistic risk for all segments, and can be kind of leading almost like a false positive or false indicator of underwriting or risk assessment, depending on the scenario. So while unemployment is beyond nominal levels, we are, to your point, seeing higher rates of employment in certain professions. So no lender, if you're a lender listening to this, no lender is immune from that, especially if your model's traditionally been relatively resilient. The economy is changing. The landscape is changing right now.
Yeah, that's exactly right. And just to add to that point, because I am kind of a credit scoring nerd, but traditional credit scores are much more heavily weighted on a historical willingness to pay, and they don't really have very good signals on ability to pay, right? And so just to use like one example that I think is very relevant when lenders think about how to manage portfolio risk, you know, in a traditional FICO score, one of the big factors that you look at is number of inquiries. So number of times a consumer has applied for credit. Well, the reason that lenders look at that and why the FICO score and the Vantage score have traditionally kind of cared about number of inquiries is it is a lagging indicator of financial distress. And so if someone loses their job or knows that they're about to lose their job or thinks they might lose their job, one of the things they might do is they might go out and apply for a bunch more credit before they lose all ability to access additional liquidity. So it's essentially shoring up their liquidity. And then that shows up as them having 7 inquiries in a 1 month span or whatever the particular calculation is. You can understand why that would be valuable for a lender looking to sort of manage and mitigate risk in their portfolio. But you also have to recognize that's an incredible lagging indicator. Someone might have lost their job 6 months ago, and you're just starting to see evidence of that desperation creeping in through inquiries, which you then get in a credit score that you pull when you're monitoring your portfolio another month after that. And then that's an indicator that you might want to look at those consumers and see if you can manage their risk. It's too late in a lot of cases to manage that risk, right? And so I really, really do like the ability to have more responsive real-time mechanisms to protect against those disruptions in cash flow, because traditional ways of managing portfolio risk don't always catch those in time. The other thing that I'll emphasize real quick and would love your comment on is this also protects a consumer's credit score, right? And one of the things that we're seeing as kind of a broad trend in the space is this idea that when there are disruptions to a consumer's ability to pay, and someone has to just throw their bills up in the air and pick which ones they're going to pay, which is just a horrible situation to be in, ultimately that means you're going to miss paying some of your bills. You're going to miss paying on some of your credit obligations, and you are going to damage, in all likelihood, your credit score, which is something that takes a long time to dig your way out of. It affects a consumer's ability to access credit in the future at affordable rates. And, we're seeing lots of examples. Like one that came up recently is this push that's happening on the regulatory side to exclude medical collections and medical debt from credit reports and credit scores. And the idea here is kind of similar in that, medical debt is something that can dramatically impact your ability to pay and your cash flow, but doesn't necessarily represent your unwillingness to pay or the fact that you're a bad borrower. It's just something happened that you couldn't deal with. I really like the idea of payment insurance filling in another gap here and saying, look, to the extent that we can protect consumers' ability to pay so that they can continue to demonstrate a willingness to pay and keep that credit score high and keep their access to affordable credit high, that's another benefit to this, right?
Absolutely. And I do like your framing of separating out willingness versus ability to pay. And what insurance does is it helps protect someone's ability to pay against those unforeseen events. And credit scores and monitoring and maintenance of a credit score and access to cash is unfortunately does have a snowball effect where a
Yep.
consumer misses one payment or a couple of payments or have multiple inquiries or may have defaulted on a loan that hurts their ability to pay in the future. Doesn't mean that they don't have the willingness to pay in the future, but as their credit score is damaged, their access to cash, when we all have an ongoing need for access to cash at different periods of time for purchases or unexpected expenses, their access to cash decreases. And that
Yep.
just leads to it being more and more difficult for someone to repair a damaged credit score. So really, truly, unfortunately, a snowball effect. But what insurance can do is it can protect that ability to pay by providing cash flow at the time of need for the unexpected event. And when we protect consumers' ability to pay, an aspect or one of the ramifications of that is that we've helped protect their credit scores so that they can continue to have that ability to pay in the future, even if they don't experience one of those unforeseen events.
It's essential, I think, and something that, going back to the earlier part of our conversation, should be ubiquitous. So let's talk a little bit about ubiquity. Obviously, you, I think, did a wonderful job explaining how, just in terms of constructing a good insurance product, you want the risk pool to be as broad as possible, which means that in a lot of cases, selling this as an opt-in or add-on product on an individual consumer by consumer basis doesn't necessarily lead to that ubiquity. What does? How do you solve for this? And this is where I'd love for you to actually use TruStage's product payment card as an example that we can talk through, because I think this embedded insurance idea in lending is pretty exciting and helps us address some of these challenges.
When I think about bed insurance, I think about the opportunity for insurance companies to distribute their products more efficiently. So to embed it naturally within the consumer experience with the brands that they're already working with, which quite frankly is not always the insurance company. So I
Yep.
think about ubiquity of insurance. I think about what we're doing with our with TruStage's product payment card, where it becomes a component of a loan itself, becomes embedded in the loan experience and the loan, so that everyone who gets a loan from that lender automatically is protected in case of job loss or disability. So if they experience one of those events, they don't have to throw their bills up in the air and see which ones land face up or face down to prioritize, but we make the loan payments to prevent that loan from becoming delinquent and hopefully prevent it from going into default. That helps protect consumers' ability to pay, that helps protect the lender's financial resiliency. And as we were talking about previously, as loans go online, they become commodities as they're digitized. It helps with differentiation as well with this product offering. And we're seeing almost about 300 basis point improvement in conversion rates for those lenders. And as I mentioned, Cornerstone Advisors' recent study about a 20% reduction in defaults as well. And what I think about that more broadly, expand that more broadly to the industry, there's roughly about 430 billion dollars of delinquent consumer debt right now in the US.
Yep.
And roughly 20% of that is due to job loss or disability. That's about $100 billion that's sitting delinquent because of something insurance could have kicked in and helped consumers' ability to pay. So when insurance becomes ubiquitous across all loan types, we can help prevent, as an industry, about $100 billion going into debt using today's stats. And when we prevent loans from going into default, what we're doing, as I mentioned earlier, is helping capital become more efficiently deployed. That's $100 billion that those lenders could have made more loans on versus writing off. So that's the value we see at TruStage with our payment card product of making insurance more ubiquitous across all loan experiences, all loan types, so that we can make capital more efficient and credit more accessible.
That makes a ton of sense. And I'm glad you walked through the use case of how it works, right? So the idea here is that rather than it being sold on a borrower by borrower basis, it's really being sold on a lender by lender basis. So a lender signs up to offer this, it gets embedded into the product itself. And correct me if I'm getting any of this wrong, but the lender can educate the consumer that this is part of the product, both from a marketing perspective, and so it helps with differentiation, but then also post origination during the servicing experience. Hey, if you have these things happen, we want you to tell us, and we want you to take advantage of this protection, this resiliency that we can help assist with. And we want you to make a claim and to be able to protect your ability to pay. And it's all natively embedded. It sounds like the way that it works is, and again, correct me if I'm getting the experience here wrong, but when that claim goes through, in this particular case, TruStage is making payments directly to the lender on behalf of the borrower. And so it's, completely automated. That experience is just very, very simple for everyone to use, the goal of which is to have the impact of protecting against that 100 billion that's currently going into default.
Yeah, absolutely. You described the experience accurate. So the product becomes a natural component for the loan itself. The lender often advertises it as a differentiator, and we're seeing that
Yep.
helping to make that lender's marketing just more efficient, more effective at attracting more borrowers or reducing their acquisition costs. Then, more importantly, once a borrower comes through, gets a loan, it is a better performing loan. So we're creating better performing loan portfolios that have built-in resiliency against economic risks such as unemployment and also disability as well. And that claim payment is being reviewed and adjudicated by our company, the insurance company. And when we approve that when we typically decision about 50% of our claims the same day, we're making the claim payment directly to the lender to apply to that borrower's loan to ensure it goes to that loan so that the loan doesn't have to go into delinquency or default just because that person experienced a financial hardship. And what we're also hearing from some of our customers is this is a tool for their claim staff, or for their collection staff, I should say. when they're seeing their loans being passed due on payments, they're reaching out to borrowers. This is another tool in their toolkit other than just a hardship deferral. They have the
Yep.
opportunity to say, we heard about that situation. You may qualify for a payment, and then they submit a claim through us, and then we're actually able to not just defer the loan itself, but reduce the principal. And that's incredibly impactful when we think about just the average cost or hourly wage of a collections agent right now, which is $20 an hour. The cost of the
Totally.
product is roughly only 15 cents per $100 of protection. So we're also making the operations staff more efficient as well.
Yeah, I'm glad you mentioned that because I think that, obviously there are these larger scale benefits to offering this, right? It's differentiating for your brand, it's sort of creating a longer term positive relationship with the customer, it's increasing the efficiency of capital and making it easier for you to redeploy that capital. Like there's all of these sort of larger benefits. But on a more micro scale, I mean, it depends a little bit on the individual use case and lender, but this is something that can pretty easily pay for itself, given that, this 20% of, defaults is due to job loss or disability. I mean, as you just laid out with the collection agents, everything that happens once you go into delinquency, I mean, this is the reason that people going into delinquency is just generally bad all the time is costs start racking up as soon as that happens. You have collections that gets involved, you have different systems and processes that kick off. There's a whole set of sort of additional compliance and reporting requirements. Like it's expensive for lenders to have loans go into delinquency. And that's the reason why collections tends to be very much of an operationally focused activity is they're trying to reduce those costs as much as possible and make it as efficient as possible to deal with this bad outcome. So the idea that either A, this can sort of prevent that bad outcome in the first place, because as soon as a consumer realizes that they're going to, they've lost their job or they've become disabled and they can sort of proactively take advantage of this to avoid going into delinquency. Or in the case of, as you outlined, someone going into delinquency, maybe they have other stuff on their mind and they forget that they have this payment protection built in. It can be a tool to make the collection agent's job not only more efficient, but also more pleasant because they can have more of a solution-oriented mindset when they're going and talking to these borrowers and saying, look, you might have forgotten this, but we actually offer this thing that's built into your loan, and it will allow you to continue to have these payments made. As you said, it will reduce the principal. And so this isn't a deferral where when you come back, you're going to have to pick up the loan exactly where it was. This can pay the loan for the next little bit while you're trying to get back on your feet. That's an incredibly powerful new capability that just from an operational perspective really sort of changes the dynamics of how lenders deal with delinquencies.
Absolutely. And it changes the dynamics from an economic or financial perspective, but also the dynamics between the lender and their borrower. It becomes less of a adversarial or contentious transaction as well when that loan goes and when that loan becomes past due on payment. And as we talk about, there's a variety of different value propositions or benefits of this solution. But when I think about traditional financial institutions, they tend to be relatively homogeneous. But as we look at different digital lenders or technology platforms, we see so much more differentiation. So that's
Yep.
where we're going to have some lenders who gravitate towards other aspects of the product relative to others. But in reality, there are those options. Not to say that it's one size fits all, but certain lenders may focus more on operations because they have those in-house. Others may focus on portfolio resiliency or marketing competitiveness because that's how they compete. That's their right to win in the industry. So that's one of the things from my lens I appreciate about TruStage's product is it applies to a lot of different scenarios because of the variety of benefits that it can provide.
I completely agree with that. And, it is interesting because the fintech space in particular, there's just a million different ideas all being built at the same time about like, well, what if lending looked like this? And what if lending was a little bit more consumer friendly in this way? Or what if we tried to market it in a slightly different fashion? And so to your point, I think, this surge that we've seen really since the financial crisis in non-bank lending has just created a whole bunch of different types of models and different types of product value propositions. And I don't really see very many of those ideas or those propositions that wouldn't benefit from more resilient borrowers being built in at a product level. Like it kind of strengthens all of those value propositions, kind of regardless of what your particular approach is to differentiating your product and building out just a strong business model. So it does sort of seem like one of those tools in a toolkit, to use your language, that everyone would want to have. I want to end this wonderful discussion by getting you to look forward a little bit into the future. So if, and I stress if, because obviously this is a relatively new product, this is a new direction, I think, for you guys. These things take a while to kind of get to greater levels of adoption in the market. But if you sort of project forward a little bit and think about if this payment protection, this embedded payment protection or embedded payment insurance becomes a little bit more ubiquitous in the market and becomes more of just a feature that's built into consumer lending products generically, what are some of the larger impacts you think it could have on the overall ecosystem? What would you sort of expect to see if that happened?
I see four things, and we talk about the ubiquitous nature of the product. I just want to emphasize that can apply to all consumer loan types, whether that's personal loans, cash flow, or cash advances, buy now, pay later, early debit transactions. We cover those as well. Really all consumer loan types. And I see four things happening as I kind of fast forward into the future as this type of solution expands in the marketplace, in particular payment guard. What we see happening is reduced delinquency and debt. So protecting consumers' ability to pay,
Yep.
reducing the amount of defaults and delinquency by 20% due to job loss and disability. What that then allows for is expanded access to credit. It makes every aspect of the lending ecosystem more efficient. It makes the lender's use of capital more efficient as they deploy it. If private credit or secondary market investors are involved, it makes the returns higher as well. And what I've talked to you about earlier about in this podcast was the role that insurance plays as a financial service solution in the overall economy. And that is a tool of economic stability. So when we allow for consumers' credit scores to be protected through their ability to pay, we allow for lenders to become more resilient, more competitive. We allow for investors to have greater returns. We are truly providing a greater degree of economic stability. That is the role that insurance provides. It doesn't protect against risk, but it allows for rational risk taking. So we allow the economy to grow further. The last thing I'd say, and I'd hope, and I think this is good for the industry in general, and is especially good for consumers, is increased lender competitiveness. Because if we're making capital more efficient, if we're helping lenders to differentiate, if we're protecting consumers' ability to pay, we should be allowing for greater level of lender competitiveness and growth within that sector in general.
Yeah, I love that. I mean, the idea that there's going to be just allowing lenders to compete more on the margins of either businesses or customer segments or risk profiles that they otherwise wouldn't quite be comfortable with makes a tremendous amount of sense. And then the same thing applies on the secondary market as well, because you have secondary investors that are, being cautious about which providers they work with, not because they don't want to get a return, not because they don't want to deploy capital, but because, you have to manage that risk appropriately. And so the idea that insurance can allow for, more responsible risk taking, to your point, which improves accessibility, which just sort of drives lending into more of the corners of the economy where we might need it, that's incredibly compelling. I think the other things I think about with this, just to add on to that, are the impact on collections is really interesting, because to your point, this can be both a tool for sort of early stage collections. We want to help kind of get you back on your feet. We, want to provide all the different tools in the toolbox to allow for a really positive resolution if you fall behind on your payments. Well, at the same time, it probably also does ideally sort of reduce the amount of really late stage collections and recovery type stuff, which tends to be where the less pleasant behavior in collections and recovery is, where it really is much more adversarial, and preventing, consumers and lenders, quite frankly, from getting into that stage, at least as much as they do today. That is deeply appealing to me. And then the other thing, and then Danielle, I'd love your quick comment on this, is I think it also, I've talked about this before in the newsletter in the context of sort of more rational product design and product usage, but there have historically, I think, been in financial services products that are used by consumers in a somewhat irrational fashion that's to the benefit of the lender, but not necessarily to the borrower, right? And so I think about this sometimes in the context of like credit cards, and the fact that, with credit cards, obviously lenders don't want consumers to completely default on a credit card payment. and to have to write that loss off on their books. That's a bad outcome. But there are definitely, certain credit card issuers that orient their business model towards, it's okay if our consumers drive right up close to the edge and there's a bit of a disruption in their cash flow and they have to revolve a balance for a few, consecutive months. That's, not necessarily great for their financial health, but it's going to increase our profits. And it's been really interesting with buy now, pay later and with some of these new products that have come into the market, sort of challenging the usage of some of these types of products and go, actually, this is probably not the most aligned way to make money while also, making sure that we're doing everything we can to protect our consumers' financial health. I really like the idea of this product being sort of a backstop to be able to drive more aligned business models and sort of product concepts where it's like, we want to design this product so that we make money when consumers pay it back on time. And there's really no disruption in their cash flow. There's no sort of irresponsible usage of this product. Like, we want to be aligned with our consumers' interests as much as humanly possible.
Yeah, I think about that in terms of like just doing good while doing well. Those aren't two distinct concepts. There absolutely is an opportunity for lenders or solution providers to be profitable, help the consumer, but do it in a way while doing good while still doing well. And I think that's the value. And I think about more financial services holistically versus through a silo of just one solution. I think when we're looking at just a mono product line solution, sometimes the results for the consumer aren't always in their best interest, or it's used unexpectedly. And that's where I think we just need to think a little bit more broadly, more strategically across all financial products of what solutions can we create together across the industries to ensure that we're helping consumers while also providing profitable outcomes for our respective businesses.
I could not agree more with that. And I think that's a wonderful place to end. Danielle, you've been very, very generous with your time. I knew we'd have no trouble filling up a good conversation on this topic. As always, I really appreciate you educating me on this and making me get smarter. So thank you for taking the time. It was a delight to talk to you.
Been a pleasure. Thanks, Alex.
Thank you.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.